Okay, picture this. You walk into a bank, you're ready to open an account, and the very first thing the teller asks you is, will that be a current or a savings account? It sounds like a super simple question, right? But honestly, if you aren't absolutely sure about the differences, that one choice can completely dictate how you manage your money, whether it actually grows, and how much financial flexibility you're going to have on a daily basis. So wondering whether to open a current or savings account? Well, you are definitely not alone.
Welcome to This Explainer. Today, we're on a really core mission, demystifying commercial banking by putting these two essential accounts head to head. Essentially, if you run a business and need to make endless daily payments with an overdraft facility, withdrawing more than your balance, you need a current account, even though it pays zero interest. But if you're a household or a salaried worker looking to safely park your surplus cash and earn a low rate of interest with limited monthly transactions, well, a savings account is your go-to choice. Let's unpack exactly why that is.
Okay, let's dive into this. Here is our roadmap for the showdown today. First, we'll look at the bank account dilemma. Then, we'll be defining our core accounts, exploring the interest rate divide, unpacking the overdraft facility, and finally, delivering the final verdict. Let's start with Section 1, the bank account dilemma. Commercial banks are basically giant financial toolboxes, offering a whole variety of tools. And just like using a hammer when you really need a screwdriver, choosing the wrong bank account can end up costing you money in missed interest, or it can totally kill your flexibility when you need to make urgent payments. When a bank accepts deposits, they generally offer a few distinct pathways. There are things like recurring deposits and fixed deposits, which are awesome for locking away money for a set amount of time, but our two main heavyweights for handling your daily accessible money are the saving account and the current account. Out of the whole banking landscape, these are the two most common contenders by far, but they serve two very, very different masters.
Moving on to Section 2, defining the core accounts.
So who exactly are these accounts designed for? First up in the ring is the savings account. If you are a household manager, maybe a student, or a salaried worker who's just looking to safely park your surplus cash, the savings account is absolutely your go-to choice. Its entire purpose is right there in the name, saving. It's built to help you develop a habit of thrift. Because the bank expects this money to sit relatively still, they let you safely store it, but they do place some limits on how many times you can withdraw from it in a month. For example, they might say you can only issue 5 checks a month.
But hey, contrast this with our second contender, the current account. This thing is a completely different beast. If you run a business, a shop, or a company, and you need to make endless daily payments, like paying suppliers, receiving money from customers, moving funds constantly, this is the account built specifically for you. It's of a continuous nature, meaning business owners can operate it with absolutely no limit on the number of transactions in a single day. You literally need to write 50 checks by noon? No problem at all. The current account gives you ultimate operational freedom.
That brings us to Section 3, the interest rate divide.
Now, in the financial world, ultimate freedom usually comes with a bit of a trade-off. And this brilliantly illustrates the classic battle of making your money work for you versus having total operational freedom. With the current account, you get zero interest paid on your deposits. Literally nothing. Why? Well, because the bank knows you might withdraw that money at a moment's notice to run your business, so they just can't reliably use it to make long-term loans. You're sacrificing interest for transactional freedom. On the flip side, the savings account pays a low rate of interest. It's definitely not going to make you a millionaire overnight, but because you've agreed to those limited withdrawals, the bank rewards you by slowly growing your idle money.
Next up, Section 4, understanding overdraft facilities.
At this point, you might be thinking if the current account pays zero interest, why on earth would anyone want it? Well, aside from the unlimited transactions we talked about, the ultimate tiebreaker for businesses is a specialized financial tool called the overdraft facility. Think of it as your emergency financial cushion. By definition, an overdraft is a short-term advance given by the bank that allows a customer to withdraw more money than they actually have in their account balance, up to a pre-agreed limit. So, if your account hits zero, your business doesn't just crash to a halt. The bank steps in to cover the gap. And the best part? You only pay interest on the daily outstanding balance that you actually overdraw, not on the entire limit available to you.
I really want to emphasize this heavily because it is a massive differentiator. This lifeline is exclusive to current accounts. Overdraft facilities are simply not available on standard savings bank accounts. No way. Businesses desperately need this tool because, let's face it, cash flow can be wildly unpredictable. Sometimes you have to pay your suppliers on a Tuesday, but your clients don't end up paying you until Friday. The overdraft bridges that exact gap seamlessly, without you having to apply for a whole new loan every single time. Now, what's really interesting about this is how the math actually works in the real world. Let's make it tangible. Suppose a business owner has 200,000 rupees sitting in their current account. Suddenly, a massive, urgent shipment of inventory arrives, and they need to write a check right then and there for 300,000 rupees. If this were a savings account, that check would bounce, for sure. But because it's a current account with an overdraft limit, the bank honors the 300,000 rupee check. The resulting overdraft is simply the 100,000 rupee difference. The business keeps moving, the supplier is happy, and the business owner only pays interest on that 100,000 rupees for the short little period it takes them to deposit more funds and bring the balance back above zero.
Finally, Section 5, the final verdict. So the crucial point is really bringing all these facts together so you can make an informed, confident choice about where to actually put your money. It all boils down to 3 key areas. Let's recap. Utility. If you're a business needing daily transaction freedom, Current is for you. If you're a household saving money, choose Savings. Rate of interest. Current pays absolutely zero, while Savings gives you a low, steady growth rate. And finally, the overdraft. That absolutely vital business lifeline is available on the Current account, but completely absent from the Savings account. They're just 2 distinct tools for 2 very distinct jobs. Which brings us to our final question for you to consider today. Take a look at your own life stage and your financial needs right now. Are you looking to safely park your surplus cash and let it quietly earn a little extra? Or are you stepping into the entrepreneurial world where you really need to power nonstop daily business transactions and have the safety net of an overdraft? Knowing the answer to that question means you'll never choose the wrong financial tool again. Thanks so much for joining me on this explainer, and I'll catch you on the next one.